Most financial experts tell you the same boring advice. Just invest $500 every single month into the S&P 500, wait 30 years, and you'll be a millionaire. They call it dollar cost averaging, or DCA. But what if I told you that this safe strategy is actually costing you millions? Today, I backtested 3 different investment strategies over the last 25 years, from the dot-com crash of 2000 to today. The results were shocking. One investor invested the most money but got mediocre returns. Another invested the least money but retired the richest. Let's break down the numbers to see who won. Let's go back to January 1st, 2000. The markets are at an all-time high. Enter our 4 friends. First, there's Mark. He just inherited $10,000. He believes time in the market beats timing the market. So he dumps all $10,000 into an index fund on day 1. He is our lump sum investor. Next is Sam. Sam doesn't have a lump sum. He decides to invest $500 every single month, consistently. He represents the standard DCA strategy. Third is Johnny. Johnny starts small, investing only $250 a month. But he sets a rule. I will increase my contribution by 10% every year as my salary grows. This is called escalating DCA. And finally, there's Rick. Rick starts with $500 a month just like Sam, but Rick has a secret plan. He isn't going to follow the herd. He is waiting for a crash. The experiment begins, and disaster strikes immediately. The dot-com bubble bursts. In March, the market drops 8%. In April, another 6%. By the end of the year, portfolios are destroyed. Mark, who invested his entire lump sum at the peak, is devastated. His portfolio is down massively. He is paralyzed with fear. Sam is scared, too. He thinks about stopping his monthly contribution, but he remembers the advice. Just keep buying, so he continues his $500 payments. But this is where Rick changes the game. While everyone else is panicking, Rick sees a discount sale. He cuts his expenses. He stops eating out. And instead of $500, he bumps his investment up to $1,000 a month during these crash years. For 5 brutal years, from 2000 to 2004, while the market was flat and boring, Rick poured every spare dollar he had into the market. And then, in 2005, he stopped. You heard that right? Rick stopped adding new money in 2005 to enjoy his life. He just let his early investments sit there. Meanwhile, Sam and Johnny kept investing for the next 20 years. Fast forward to today. Who won? Let's look at the numbers. Let's talk about Johnny, the guy who increased his investment by 10% every year. Johnny actually invested the most total money out of everyone, over $300,000 of his own cash. But his returns, surprisingly average. Why? Because of the time value of money. Johnny's biggest contributions happened in the last few years when the market was already high. His big money didn't have enough time to compound. He worked hard, but his money didn't work hard enough. Mark, the lump sum investor, recovered, but his returns were crippled because he bought the peak. Sam, the standard DCA investor, did better, building a solid nest egg with a decent return. But the clear winner is Rick. Remember, Rick only invested heavily for the first 5 years when the market was down, and then stopped. Even though he invested significantly less total money than Johnny, his portfolio is worth double. Why did Rick win? It's simple math. When the market crashes, most people get scared and pause their investing. Rick did the opposite. He bought maximum units when they were cheapest. Because he front-loaded his money early, those cheap shares had 20 years to compound. The lesson for 2026 is simple. We are likely heading into volatile times. Most people will pause out of fear. Don't be Mark. Don't even be Sam. Be Rick. When the headlines say, "Market crash," that is not a signal to run. That is a signal to double down. Because the investments you make in a crisis are the ones that buy your freedom. If you want to master the psychology of money, hit that subscribe button. I'll see you in the next one.